Welcome to Chapter 3, Bond Valuation and Pricing. Welcome back, financial enthusiasts. Today, we're diving into the exciting world of bond valuation and pricing. Understanding how bonds are valued and priced is crucial for making informed investment decisions. So, let's get started. Introduction to bond valuation. Bond valuation is like solving a puzzle, a way to determine the fair value of a bond. Just like any other financial instrument, the value of a bond is influenced by several factors. Let's uncover these puzzle pieces together. First, let us understand the components of bond valuation. Bond valuation comprises two primary components: the present value of future cash flows and the market's required rate of return. Present value of future cash flows. The present value of a bond's future cash flows includes both periodic interest payments, known as coupons, and the bond's face value, which is paid at maturity. Let's see how it works. Calculating present value. Let's take a hypothetical bond with a face value of 1000 rupees, a 5% coupon rate, and a 5-year maturity. To find the present value, we discount each future cash flow back to the present using the market's required rate of return. The formula is PV equals CF 1 plus R caret N, where PV equals present value, CF equals cash flow, coupon payment or face value, R equals discount rate, required rate of return, N equals number of periods until the cash flow is received. And then, add up all the present values of future cash flows to find the total present value of the bond. You also need to adjust for accrued interest. If you're buying or selling a bond between coupon payment dates, you may need to adjust the bond's price for accrued interest. Market's required rate of return. The market's required rate of return is a critical piece of the puzzle. It represents the yield investors demand for taking on the bond's risk. Various factors, such as interest rates, inflation, and credit risk, influence this rate. Relationship between bond prices and interest rates. Now, let's explore the fascinating relationship between bond prices and interest rates. Bond prices and interest rates have an inverse relationship. When interest rates rise, bond prices fall, and vice versa. Impact of interest rate changes. Imagine a bond with a fixed 4% coupon rate. As market interest rates rise to 5%, new bonds with higher yields become attractive to investors. Consequently, the price of our bond with the 4% coupon decreases to align with the new market rates. Factors affecting bond pricing. Bond pricing is influenced by several factors, including credit quality, time to maturity, and prevailing economic conditions. Interest rates. Changes in prevailing market interest rates have a significant impact on bond prices, as seen above. Credit quality. The creditworthiness of the bond issuer plays a crucial role in determining bond prices. Bonds issued by entities with higher credit ratings are considered safer investments and, therefore, tend to have higher prices. Conversely, bonds from issuers with lower credit ratings may have lower prices due to increased risk. Time to maturity. Bonds with longer maturities are generally more sensitive to changes in interest rates than short-term bonds. Longer-term bonds carry more risk, as their future cash flows are subject to a longer period of interest rate fluctuations. Economic conditions. The overall state of the economy can influence bond prices. In times of economic uncertainty or recession, investors may seek safe haven assets like government bonds, driving their prices higher. And, during periods of economic growth, investors may take on higher risk investments, leading to lower bond prices. Inflation expectations. Inflation erodes the purchasing power of fixed income payments. As a result, investors demand higher yields on bonds to compensate for potential inflation. If inflation expectations rise, bond prices may decrease, and vice versa. Supply and demand. The supply and demand dynamics in the bond market directly impact bond prices. When demand for a particular bond is high, its price may rise, and vice versa. Factors such as central bank policies, investor sentiment, and market liquidity can influence supply and demand. Market sentiment. Investor sentiment and perception of risk can drive bond prices. Positive news and a favorable economic outlook may boost bond prices, while negative news or heightened uncertainty may lead to price declines. Call or put features. Bonds with call options, callable bonds, or put options, puttable bonds, give issuers or investors the right to redeem or sell the bond before maturity. Investors may be willing to pay more for bonds with favorable call or put provisions. And finally, currency exchange rates. Fluctuations in currency exchange rates can impact international bond prices. Changes in exchange rates may affect the value of coupon payments and principal amounts received by foreign investors. Understanding these factors helps us predict how bond prices will move in the market. Bond pricing and market value. Bond valuation helps us determine whether a bond is trading at a premium, par, or discount to its face value. When the bond's price equals its face value, it's said to be trading at par. When the bond price is above the face value, it's a premium, and below the face value, it's a discount. Congratulations! You've mastered the art of bond valuation and pricing. Armed with this knowledge, you can confidently evaluate bond investments, understand their fair value, and make sound financial decisions. Thanks for watching.